record Okay, good. So let's go ahead and let's jump into 16 here and start talking about accounting for income taxes. Now, let me start out by making sure that we understand that this is not a lecture on tax law. Okay, this is not a lecture on this is how you prepare an IRS tax return. That's a tax class, okay? What we're talking about here is a situation where the client is doing their financial accounting, but when they look at their tax return, the net income on the tax return is different than the net income on the financial statements. Now that happens because what? Our GAAP rules are different than our tax rules. So we'll have two different net income numbers, right? Okay, and so what happens? We're going to see that that difference is going to be in part, most of what we're going to talk about, generated by something called temporary differences between our tax income and our book income. Okay, and so what we're going to have to do is take a deferred tax liability or a deferred tax asset when that happens. And it happens every period because there's always difference between the tax rules and the GAAP rules, okay? If we have a deferred tax liability, what that means is that our net income for the current period was more than our taxable income. And in the future, we're going to have that difference turn around and we'll have to pay more tax in the future when that difference turns around. That'll generate a deferred tax liability. Sometimes we're going to have a situation where our taxable income is more than our book income. If that's the case, we look at it from the standpoint of the financial statements, since we're preparing our financial statements here, and we say, you know what? We're prepaying our tax. We're paying it in advance. We're reporting more income over there on the tax return. We're paying our tax in advance. We'll have a deferred tax asset, okay? So that's what we're going to do, and we're going to get through that discussion today so that our heads don't explode. I'm not going to deal now. We'll deal with it next time if we have loss carry forward or carry back, because IRS allows us to take future losses against our past income, and that can generate a deferred tax asset and liability. But I think it'd be hard for us to hold all that in our head for one day, so we'll do that next time. And then we'll do the quiz questions next time for Chapter 16. And as I've stated, then we'll just have Chapter 17 left, which is pensions. And I'm not going to go too heavy on pensions because most companies don't use deferred benefit plans anymore. And when we look at pension, we're looking at accounting for deferred benefit plans. But we'll spend a little bit of time with it. Okay? All right. So let's go ahead and let's take a look at the conceptual underpinning, which I really have already talked about. I probably should have this slide up before, in that what? We have differences between our book income and our tax income, right? And those differences will arise to deferred tax liability or deferred tax asset, okay? And so we're going to look at the difference here as some terminology here, really, which is temporary difference. Temporary difference is a difference that originates in one year and then reverses in a later year. Okay, examples here: reporting for financial purposes in the year of sale and reporting for tax purposes when we actually receive the cash. So if we're a cash basis taxpayer, or the tax law simply says we have to actually receive the revenue before we will take that as income. Yet for GAAP purposes, we don't worry about when we receive the cash. We worry about when the revenue was what? Actually earned per our revenue recognition rules. Okay, so what happens? A temporary difference originates in the year the installment sale is made and are reported in the income statement, and it reverses in future years when what? When we actually collect that cash and finally report that for tax purposes. Now, the way they're describing this is going to result in a deferred tax liability, because what? We're sitting there and we're saying, hey, we've earned this revenue. It's part of our income. And if you multiply that by the tax rate, that's our tax expense. But we're not going to pay that until what? Future periods when we actually have to report it to the IRS for tax purposes. And I'm just going to talk IRS. It would work the same way with state taxes. But when we actually have to report that as income to the IRS, then we're going to owe them the tax on that, aren't we? So we set up a deferred tax liability in the period it originates. When we've taken it for book purposes, we'll hold that liability until what? We finally report that income for tax purposes, and we pay the tax on that. Okay? So we come over and we take a look at the deferred tax liability. That's when we have already taken the income for book purposes. We'll take it later for tax purposes. That's the liability. In some cases, we may have what? We may have income that we had to take already for tax purposes, like an unearned revenue, let's say, but we won't take it for tax purposes until we do what? Or we've actually earned the revenue for tax purposes, but we won't collect that until later. What are we going to do? We're going to strike that. Correct what I said the first time. We have taken that revenue for tax purposes, so we paid the tax on it. We have an unearned revenue, but what? We're not going to take that for book purposes until later, so we have an asset. We have, in effect, prepaid that tax. Okay, that'll be a deferred tax asset. Okay, we're going to see, guys, that tax expense is going to end up being the plug figure between whatever we set up as our deferred tax liability, our tax or asset, could be either, our tax payable for the period, which is basically the check that we're going to write to the IRS, and our tax expense will be the plug figure between those two. Okay, and I'll show you how that works here in a couple seconds. Okay, so let's just take a look at this example. I just want to get all the information on this slide up front. Okay. And so we have this Kent Land Management, and they reported pre-tax income in 2018, 2019, and 2020. And you can see the respective amounts: $100 million in 2018, 40, and plus an additional $40 million from installments. So we have our pre-tax accounting income, $100 million plus an additional 40 from installment. However, the installment sale income is reported on the tax return when it's collected in 2019, $10 million, and there'll be $30 million in 2020. So what happens? We take a look, and you have the 140 that we reported pre-tax, but for tax purposes, we'll do what? We'll report this 100,000 because we're going to collect what? The additional 40, 10 in 2019 and 30 in 2020 in future periods, right? So we're going to have to pay that tax in the future. So we're going to have a deferred tax liability, aren't we? Right? And so if we come over and we take a look at how we calculate that deferred tax liability, and it's pretty simple, guys. You simply take the amounts that you're going to report as income in the future, and you add those together. 10 in 2019, 30 in 2020. Okay, so that's 40 additional taxes, 40 million, I guess. Was it 40,000 or 40 million? Whatever, 40 additional taxes that we're going to have to pay here. And notice that what? That our taxable income for this year was only 100,000. Meanwhile, our book was 140 because we've already determined that we have earned that revenue for book purposes, right? Okay. So we take that, what? That tax that we're going to have to pay in the future, and we multiply it times the income we're going to take in the future. We multiply it times the tax rate. That's something that we're going to have to pay in future years, right? When we finally go ahead and take that income and have to pay our taxes on it. So if the deferred tax liability at the beginning of the period was 0, and we need now 16 as that liability, our deferred tax liability will be credited this period for 16. And so you come over and you take a look at the journal entry here, and we do what? Our deferred tax liability is 16. That's the amount we have to put in there. That's that credit, right? And then you take a look, and my income tax payable is whatever I have on my tax return times what? Times the tax rate. That's what I'm going to send a check to the IRS for, right? Is this a check to the IRS? Hello?
No.
Yes, it is. This is a
only 16 million to the IRS.
No. This is a check to the IRS in 2018, Arthur. Do you go by Art or Arthur? Or neither? Arthur's okay. Okay, so we have a check that goes to IRS for 40. That's what we reported on the tax return. Okay, when it says this is your net income that you report on the tax return times your tax rate. This is the tax you owe, whatever they say on there. So that's the 40 that's going to them now, right? 16 is going to go to them what? In future years. In fact, I can tell you right now that what? 4 is going to go next year, and what? And 12 is going to go the year after that, right? Okay. And so that will go in future years. And then the way you come up with the tax expense, remember we said was the plug, which is simply the total between the tax that is what? That I'm paying now and the tax that I will have to pay later, right? Is going to be the sum of those two. Okay. Now, sometimes I'll mess with this just for fun, and I'll just go ahead and I'll put 140 times 0.4. Does that give me 56? Right? Okay, so that's my tax expense. If I were to say, hey, here's the tax I owe for what I made for book purposes this year, remember our orientation is what? Is the book purposes in this stuff. We're not talking about how to calculate the taxes and the tax. If we were doing this in a tax class, nobody would even pay attention to the concept of deferred taxes, right? So I'm just saying, from the book purposes, you could say your tax expense is that. That's why we're reporting it. But be careful, guys, because what happens is when we look at some of the problems, the evil question will not give you this number. And they'll still ask you the tax expense because they're expecting us to understand that it's what we're paying now versus what we're going to pay later is this year's tax expense, okay? So it's better off, and I'm going to keep focusing on doing it this way so that then when we look at the problems, it's not as much of an adjustment for us to switch and say, oh, okay, I have to do it this way for this problem because they're not giving me the book income. Okay? Question?
So pre-tax is book income.
Pre-tax accounting income, is book. I'm sorry. Some literature will call it book income. Accounting income, same synonymous terms. Okay, good. Now, the burning question must be, well, what happens in 2019? Well, in 2019 now, I take a look and I have what? I don't like the way they presented this. Let me just write it down the way I would look at it. I would look at it in 2019. That what? If you look back at the previous slide, whatever, this one here, 30 is supposed to turn around now in 2020, isn't it? 30 will turn around in 2020, right? And so when I'm in 2019, I'm looking and I'm saying, well, if that's the case, if it's going to be what? 30 million that's going to turn around in 2020, and I'm now looking up here at 2019 right here, then I should take the amount that's going to turn around in the future, which is what? That remaining 30 times 0.4, that means I need what? I need 12 in there, don't I? Okay. How much is sitting in there at the beginning? 16. So the amount that needs to come out of there now is what? Is this 4, and you could look at the 4 if you wanted to by saying what? 10 times 0.4 is 4 that's going to be recognized this year. Okay, but I prefer to do it, and this is really what you would do. You would look at what? Amounts that are going to be paid in the future. How much do I need in the deferred tax liability account for amounts that are going to be paid in the future, right? And in this example, it's just that 1 year that's left, the 30, right? 30 times 0.4 means I need 12. And if I have 16, then I need what? I need 4 more, okay? And I mean, I need to take out 4 so that I end up with 12. So I would debit the deferred tax liability. My income tax payable is going to be what? My taxable income times the tax rate. Taxable income was right here. It was what? It was 110, right? So my taxable income, 110 times the 0.4 gives me the 44 million is my tax that my check that I'm going to send to the IRS, and then we're just simply going to plug the income tax expense, right? Okay. Okay, so again, process is to do what? Look into the future, see what the additional taxes you're going to have to pay in the future, multiply that by the income that you're going to take in the future, multiply that by the tax rate. That gives me the liability, and I just adjust it to whatever I need to bring it to that amount. And this is how you would actually do it, because you're not going to be going back and saying, well, how much did I think I was going to take this year versus, because you don't really know for sure. From year to year what it was you said, and it might be different that next year. So you're not going to be going back to see what you thought you were going to take. You simply do what? You'll know what for all your temporary differences is at the end of any current year. You're going to know what they are. You're going to know what they result in, either a tax liability or a tax asset. Multiply that times the tax rate, and that's the amount that you need in the deferred tax liability account, right? And then you just adjust it accordingly and then plug the tax expense from there. Okay? Okay, good. Now you come over, and I don't care about this slide. Let's look at this question though. Okay, see what we have here. So we've got this company, and shortly before the end of 2018, Coulter Company makes an installment sale that generates $400 of before tax income. Coulter recognizes income for tax purposes when the sale is made, but will recognize the income for accounting purposes when the sale is made, but will recognize income for tax purposes when the cash is subsequently collected in 2019. Coulter has a tax rate of 40%. As a result of this transaction, Coulter's tax expense, and so we look at this, and this is one of those where they're going to make us figure out the tax expense for the future, right? So if we have 400 before tax income, but we're not going to take that for tax purposes, for book purposes, okay, we take it when the sale is made. But if we're not going to report that for tax purposes, then we're going to into the future. Then we have what? $400 of income that we will take in future years, right? Question? We have $400 that we're going to be taking in the future. Now we take that $400 and we multiply that by what? By 0.4, so that now becomes 160 that we're going to sit there and we're going to need to put into our deferred tax liability, right? And if the beginning balance was 0, then we'll have to credit deferred tax liability for 160, right? To bring it to the ending balance that we need of 160. So far we've credited deferred tax liability for 160 because we're going to pay that in the future. And then what? Then we sit here and we say, well, look, they said the tax expense that we should report is going to be what? Well, our tax expense is going to be based on this $400 of income. $400 of income times what? Times 0.6 here. times 0.4, which I don't have to write that again, is, 400, excuse me, that we're taking now times the 0.4, yeah, is 160, right? So that's also going to be my tax expense, and since I haven't taken any of this for income, I don't have a tax payable, right? So the tax expense has to be what? Has to be a debit. What did they ask me for? Oh, the journal entry to record this, I don't know why I'm giving you the expense, is a what? Credit to the liability account. I already gave that to you. Right here. Okay. Now, the debit to the tax expense here that I was trying to explain to you. Let's just go ahead and erase this out of the way. The debit to the tax expense is what? The same as the credit to the liability, because right now I haven't reported anything to IRS, right, as income. So presumably, at least based on the facts of this, there'd be nothing due to IRS, so there'd be no tax payable. So the tax expense equaled the deferred tax liability here because there's nothing currently payable to the IRS because I haven't taken income on that yet. Okay? Okay, good. Let's take a look at this one now. We've got this Windsor company started 2018 with a deferred tax liability of $150. You can see that there. Okay. As of the end of the period, Windsor identifies future taxable amounts of $500, and we have a tax rate of 40%, and calculates the tax payable is $120. What's the tax expense? And this is what I was saying before. That's why you can't just sit there and take the book income and multiply by the tax rate usually, right, to get the tax expense, because of the way these problems work. But if I have 150 and I'm sitting there and I'm saying that I have what? I have 500 of amounts that'll be taxable in the future. 500 times what? Times 0.4 means I need how much in there? 200, but I already have 150, don't I? So I know I have to credit the deferred tax liability. I'll just write it up here. For what? For 50, and then the way I ended up writing this, it makes me have to write it on the debit side, which I don't want to do. And here we go again. I'm right back where I started from. I want it to be a credit, damn it, even though they're making me write it on the debit side here, whoever they are. Okay, so that's a credit. That's that credit right there. I mean, not of 200, but of what? Of 50. I'm just trying to show you in general journal form here. That's 50, okay? And then what? And then I have to go ahead and write a check to the IRS for what? They tell me tax payable is what, 120? So the tax payable is 120. So can I figure out the tax expense then? Can I figure out the tax expense? Yeah. Got to be 170. It's the plug to make this journal entry balance, isn't it? Okay. Now, granted what? Theoretically, I suppose I could have done what? I could have sat there and had the book income and multiplied that times the tax rate and got the same answer, but on some of the questions that I'm going to be giving you, they're not going to give you the tax expense. And the reason that we look at it this way is this is essentially what the company would do. They would sit there and look at the future amounts, right? And figure that that's what they have to adjust to come up for the new tax liability. And we'll see in a while, it could be an asset, deferred tax asset. Okay? Okay, good. And that's the same answer there. Okay, so what this table does, okay, and it's probably a good flashcard for you, okay, if you make flashcards or whatever, but remember this slide, because this does a good job here of helping you to remember how to treat these different items, okay? So what happens? Items that are reported in the income statement now, but on the tax return later, and they kind of leave off something important here. If it's reported on the income statement now, but on the tax return later, is that going to be a deferred tax liability or asset? That's what? A liability, because we're going to report it on the tax return later, right? And have to pay that tax, okay? If something is reported on the tax return now, but on the income statement later, remember, guys, we're looking at it from the standpoint of our financial reporting, right? So we're sitting there and we're saying, you know what? We prepaid that tax, didn't we? Right? And so that's going to be an deferred tax asset, right? Okay? All right, so we understand the direction this table is going. Now let's go ahead and take a look at some of the examples of some items, okay? So we say what? Installment sales for a property installment method for taxes. What happens? We go ahead and we take the income now, don't we? We take the revenue now, and we won't take that as revenue until what? Until later in the tax return. So we have taxes we're going to have to pay in the future. Unrealized gain from recording investment at fair value. And so it's unrealized gain now. We're taking this as our income statement gain, right? And what's happening? We won't take it as income until later on when we actually sell that asset. So that's going to generate a tax liability, right? Okay. When we look at it from the expense side, estimated expenses, we take an estimated expense, for example, and Arthur, I think you'd asked the warranty question. You're saying, well, what about taxes? And I'm saying, well, taxes, we won't take that until we actually incur the warranty expense. I think we had a conversation, something like that. And so what's happening? Well, we're going to take that expense now, and so we're doing what? We're having lower net income, less tax, right? And so we're not going to pay the tax on that. But then what? Then later on, this is going to turn around, and we're going to take that as a deduction later, okay? Unrealized loss from recording investment. We're taking that loss now, but we won't take that loss for tax purposes until later on, right? Okay. Accelerated depreciation. What happens here? We take more, and I guess these are going to result in what? Asset on this side? Right? Because we already took the... no, that's a liability. No, that's going to be an asset. Yeah, asset, because we got what? We've got a deduction and a loss that we still have yet to take for our future purposes. So we have what? We have lower income, lower taxes that we're going to have to pay in the future. So that's an asset on this side. Here, what happens? We take a depreciation, and we take depreciation at an accelerated rate for tax purposes. Tax will allow you to take a faster depreciation than most accounting methods will. Why is that? Why would tax allow you to take a depreciation faster? Who writes a tax law? Huh? Government, Congress, signed off on by the president, I guess, when they can ever get done yelling at each other long enough, right? I guess they'll pass it. I don't know what they're going to do. I think they're getting ready to, like, start firing nuclear weapons the way they're acting. But anyway, so what happens? We sit here, and the Congress, the president, wants us to take depreciation faster for some reason, right? Why would they want us to take depreciation faster? What good is it if I take depreciation faster? I get a what? I get a better tax deduction sooner, right? I'm taking depreciation on that, and the idea is that that may encourage me then to take that tax savings and invest in more property, plant, and equipment. Now we're into economics, right? If I'm investing, then you have the, I don't know what they call that, the accelerator effect or the multiplier effect. I'm not an econ guy, but whatever, it's going to do what? It's going to spark the economy, right? Okay, so what's happening? I'm taking depreciation faster, so I'm really getting a deduction too soon as far as my book purposes are concerned, right? Later on, what's going to happen? My tax deduction is going to be smaller, and let's say I was using straight line, my book deduction will stay the same, right? So I'm really what? Going to have to pay more tax in the future, right? So this results in a liability, doesn't it? This is liability, okay? Now, prepaid expenses, what happens here? Well, I'm going to prepay my insurance, let's say, and I get to take that as a deduction immediately when I pay it for tax purposes, but what? Book purposes, that expense is what? Not going to hit till later, so later for tax purposes, my deductions will be smaller, won't they? And so that's going to result in a liability, okay? So this is a good table in that it sort of helps you to kind of group what we're going to be looking at into these, I guess 4 different categories, and then they give you some examples, and we're not going to necessarily be tied exactly to these examples, but you can, through analogy, understand how some of the other things we'll look at will work. Okay? Okay, good. So let's go ahead then and let's take a look at this example, okay? And this is a deferred tax liability from expenses, deductions, whatever, being reported on the tax return before they are on the income statement, okay? Now, you take a look at this, and the way we're going to be calculating this is we have the 100 million pre-tax income, and then they add the depreciation back and then subtract the depreciation from the tax return, and that's a little bit of a confusing presentation. I think I understand why they're doing it that way, but let's just look at the difference. So we have what? We have 8 whatever more that's being taken for tax purposes, 25 for book, 33 for tax, that's 8 more. Hello? Right? Okay, and then over here we've got what? We've got the 25. These guys must be using straight line, right? And we've got 44 for tax purposes. Is this an accelerated tax method, this MACRS, whatever? Okay, so this is 19. But then that turns around, doesn't it? And later we've got what? We've got 10 more for tax purposes than we do for book purposes, and then what? And then finally we've got 17 difference. Okay, I'm just showing you that that's the only reason that's why they added and then subtracted it back, so that we end up with a difference. Okay, so the total difference here then is going to be what? If we look at the total difference is, well, these are negative numbers, and these are positive numbers when it turns around back, right? So the total difference, I looked at it, is 8. Oh yeah, of course it's going to turn around in total. Yeah, I'm sorry, it's going to reverse out, so it should be 0, right? Okay, so it's 0, and it's going to turn around, but we're going to look at what? To come up with our deferred tax liability, we're going to look at the total difference across the spectrum here, right? To get our deferred tax liability for 2018, okay? So you go ahead and you take a look and see how they calculate that. And we have what? In that first year, we have the amounts that are attributable to future amounts are what? The 19 difference in 2019. the 10 difference in 2020, the 17. That's where I was saying, well, I was saying 8 because I was looking at the future effect of the difference, right? Okay. And then what? I multiplied that by 40%. And so I'm going to need 3.2 in my deferred tax liability because I'm going to have to pay a net of tax on 8 more dollars, right? Right? 19 more is coming in 2019. I'll have to pay tax on, I'll pay less tax there, but then I'm going to have to pay more tax in those future years when this reverses, right? Okay, so it comes out to 3.2, the 8 that is deferred. I take that times the 8 times 40%, that's 3.2. Since the beginning balance is 0, the ending balance needs to be 3.2. I go ahead and I have my income tax payable, which is what? The 92, the 100 book minus the additional tax, additional depreciation brings my taxable income down to 92. That gives me 36.8 for my payable. And then as we've said, we simply do what? Take the sum of the two. And again, we could have taken 100,000 times 40, but we're not always going to know what our taxable income is when we look at these, right? Okay, so that's year 1. Now, what do you think's or whatever year we're in, 2018? What do you think's going to happen in 2019? 2019, we're going to have what? We're going to have these amounts that are going to turn around in the future years. And so you take a look, and we have what? We have 27 that will be future taxable amounts. Okay. So now you go ahead and you add those out years, the 27, that's 40%. So we need a deferred tax liability now of 10.8, right? Okay, so now we're seeing that that's going up because what? We lost the advantage of that 1 year in which we would have less tax that we have to pay, right? Okay, and so what happens? It goes up now to 27 times 0.4. That's 10.8. We already have 3.2. We need what? 7.6 to bring it up now to these future out years where this really starts reversing on us, right? And so we go ahead again. The taxable income is going to be the tax payable currently is our taxable income times the tax rate of 40%. That gives us deferred tax liability of 7.6. which we already knew. Our taxable income is 32.4. We got that. And then we go ahead and again we plug the tax expense. And once again, you could have said 100 times 0.4, but we've already seen they may not give that to us. So now we got 1 more year left to go on this thing, don't we? Right? So our future amounts are going to be what? 17. Do you think the deferred tax liability is going to go down or come up? It's going to go down. Good, because now we're paying the tax on that amount from the previous year, the 10, whatever, for the previous year. So what happens? Sure enough, it comes down to 6.8, and so we're going to have to debit the deferred tax liability for 40 now. And again, our tax payable will be 44, and then we'll plug the tax expense, which we know is going to be 40 again, but let's just go ahead and see how that looks. We debit the deferred tax liability. Income tax payable is 44. That's the check we're going to send to the IRS. And the tax expense is 40. And then finally, what happens last year? Now there's no more future amounts, right, that are attributable to this anyway. Now, of course, a company wouldn't just have one transaction, you know, and they end up with 0 after that transaction runs itself through. But we're going to have what? Some amounts coming in, some amounts coming out, and it'll net out to either deferred tax asset or liability, right? Okay. And so we go ahead and we do the multiplication here, and we need 0 in there now. There's already 6.8, so we debit that. That zeroes it out. And we go ahead and we make the entry that we're getting pretty familiar with now. Now it's a debit to deferred tax liability again. Again, it's a debit which zeroes it out. Question? I don't know. I tried to hide these. I don't hide it. I was these stupid things. Okay. So let's go ahead and let's take a look at this question here, this Western concept exercise, Western Mountain. And what happens here? They end up here looking, and they have 5 million more depreciation for tax purposes than for accounting purposes since the company began. Okay, it ended 2018 having 4 million more depreciation for tax purposes than for accounting purposes since the company began. Assume a tax rate of 40% with respect to depreciation. What is the tax expense journal entry for 2018? Now, my first question is, what's the beginning balance in the tax liability, deferred tax liability? Beginning 2018. It's going to be 2 million. Good. It's the 5 million times the 20%, right? 40%. Okay. Good. So that's going to get. Oops. Well, now they took all the fun out of it, but you're right. I thought they would let it come down. It's what? 5 million times the 40% is 2 million, right? Okay. Then they go ahead and they say what? Well, now some of this has already started to turn around, hasn't it? And so we only have 4 million that we will recognize in future years. So that means what? We now only need 1.6 million in here, don't we? So we take that 4 million times the 40%, we only need 1.6. And if we have what? If we have 2 million, then we have a deferred tax liability debit of 400,000. Okay? Okay. What I want to do is take a quick break here. Let's go till what? 12? Very quick, and then we'll get into deferred tax asset. And we're going to see it's just a mirror image of what we've already talked about for the deferred tax liability. Then we'll look a little bit at the valuation allowance, and we'll get out of here and we'll finish this on Tuesday. Okay. And we're going to start talking about now deferred tax asset, which essentially is going to be the mirror image, obviously, of the deferred tax liability approach that we've been talking about here for the first half of the discussion. And so now we're going to have amounts that we are going to get a deduction for or not recognize into income until future periods. And so we're going to do what? We're going to assume that that's part of our tax expense now, but we're going to pay that to the IRS in the future, right? And so we will have a deferred tax asset. We get a future deduction, right, that we can look forward to, and that'll lower our taxes in the future. Deferred tax asset. Okay, and they give us example, recognizing future expenses for tax purposes. We'll take those now for book purposes. We'll get to take them for tax purposes later. Or what? Recognizing less revenue in the future for tax purposes. Okay? So we come over and we take a look at the first situation where we're going to have a expense that we'll report on the tax return after it's reported on the income statement. And so we have this example that we had talked about earlier, the warranty expense, and what happens. We take the warranty expense now when we make the sale, right? Our estimated, our contingent liability, whatever, for our warranty expense, but we are not going to be able to take those till tax purposes until the people actually come in and say, hey, my product didn't work, right? And so we're assuming that those will go into the future, and here we're assuming, hey, maybe it's a 2-year warranty and it'll happen evenly over the 2 years, and so we do 15 and 15 in the 2 upcoming years. And so we have deductions that are yet to come, don't we, for this 30? And so since those deductions are yet to come, that's going to result in less taxable income in the future, less tax. So we have a deferred tax asset, right? Okay. And so we come over and we take a look, and we have this 30,000 or 30, whatever that we're going to be able to take in the future. Our tax rate is 40%. Future amounts means that what? We're going to have to pay 12 less tax in the future when we get to take those additional expenses. So we go ahead and we set that up in the first year. Beginning balance is 0. We needed 12 in the ending balance, so we're going to debit deferred tax asset for 12. We'll credit our tax payable, and that's almost the easiest part of this calculation, which is whatever's on our tax return times our tax rate, whatever we tell the IRS is our tax liability, right? The amount you owe, that's what we're going to put as our income tax payable. And then to make this journal entry balance, I guess we need 28, right? Okay. And again, you could have taken 70 times 0.4, but we've already seen that, some problems won't give you that, right? Okay. Okay, good. You go into the next year with this thing, and we have a beginning balance of 12, and we have what? This 15 million that will turn around. It was 15 million per year. So now what? Now since we have 15 million that last year, we only need 6 as the ending balance. And so if we have 12 and we want 6, then we obviously have to credit at 6, right? Remember, it's 15 per year. So we're down now to what? This last year's 15 that needs to be left to have as a deferred tax asset. So we take what? We leave 6 in there. 15 times 0.4 is 6. We needed 6 in there, and so to bring it down to 6, we just credit it for 6. Okay, so since we credit for 6, income tax payable we've seen now is just simply going to be my 85 million net income times the 40%, and then I just plug the income tax expense for 40. And then I don't know these slides. That's it. I don't care for those. Okay, so let's just take a look. I could have sworn I sat there and hit them. Okay, so Dutch's company started the period with a deferred tax asset of 400. There it is, right? As of the end of the period, Dutch's identifies future deductible amounts of 700. Dutch's has a what? A 40% tax rate, and calculates the tax payable will be 200. So how much do we need in the deferred tax asset account as our first step? How much do we need? $700 times what? Times 0.4, because we got future amounts, right? Of 700. And so we need in here what? 280. And we have right now what? 400. So we need to credit the deferred tax asset 120, don't we? So that's going to be credit to, I'm going to call it DTA of 120. Good. Do they tell me anything about what the taxes payable are? Taxes payable, I'm going to put as TP, is 200. Do I know what my tax expense is then? Tax expense got to be 320, doesn't it? Right? Okay, so same logic we had a minute ago for, there's all the same stuff I wrote in. Same logic we had a minute ago for our liability. It's just the mirror image, right? Okay? Okay, good. Come over and let's take a look at the situation now where we have revenue that's reported on the tax return now, but we won't report it for book purposes until the future, okay? And so what's happened here? We are really prepaying the tax on that, aren't we? Right? We're taking the revenue for it now, but we won't on our tax return, but we won't take it for book purposes, so we're gonna really pay that in advance. So we have these different amounts, and notice that what? Our pre-tax accounting income is 80, but we took 20 for this subscription revenue, so people paid us for our subscriptions in advance, didn't they? And when they paid us for our subscriptions in advance, we sat there with this 20 dollars, but we're not going to earn that until later on as time passes and people get the magazine subscriptions. So we go ahead and we have that. We'll turn around in 2019 by 15 and 5 by 105. I mean by 2020. And so what happens? We sit there and we've got total amounts of 20 that we've prepaid the tax on, haven't we? Right? Okay. And so we come over and we go ahead and we got that 20 times the 0.4. So the ending balance is needed as a pre-tax deferred tax asset, I should say, of 8. So we need what? We don't have anything right now, so we need 8 in there. So we're going to debit the asset 8. We're going to credit the income tax payable 40, which again includes that additional 20 of subscription revenue that we've gotten that we're assuming we're paying the tax for in advance. And so our income tax expense is 32. Again, it's the plug. You could have taken 40% times the 80, but we've seen it now a number of times where we just don't give that to us so we can calculate correctly. Okay? Okay, good. Now you get into the next year, and in the next year now we're going to take that what? We're going to now get the tax benefit of not having to report that final 15 million. Why was it supposed to be? Supposed to be 15 million? 15 million. Oh, this is year 2, right? So we got the advantage of the additional 15 million, but the way to look at it was what? We've got, I don't know why they changed the format on us here. We have how much left? 5, and so we have 5 left, and 40% of 5 is what? $2 now, isn't it? What we need is the ending, that last year of 5. Okay? And so we take that 5 times the 40%, that's 2, and so we've got a change of what? We've got a change of 6. We credit the deferred tax asset. Income tax payable is whatever we report on the tax return times the 40%, and then we just plug the tax expense. And then when we get down to the next year, we don't need anything anymore in there by that last year, that $5, for that $5 that we had in that last year. So we simply credit the deferred tax asset to zero it out, income tax payable, and then we plug in income tax expense. Okay? Question? Okay. So let's take a look at this one. Men's Worth News Month. I don't know about Men's Worth. News Month. Okay. Has 10 million of deferred revenue. Subscriptions and News Month recognizes income for tax purposes when cash is collected and pays at a rate of 35%. So News Month balance sheet should include, and they give us the choices here. So we've got 10 million of what? Deferred revenue. That's saying that we haven't taken the revenue, but we've gotten the cash, right? And for tax purposes, we do what? We pay the tax on that now, aren't we? So we're paying the tax in advance. Okay, so we're going to have a deferred tax asset, and I'm not going to bother writing it down. I'm just going to show you the answer. I mean, it's the easiest thing in the world. Take that 10 million that we're paying the tax on now, then what? We'll take this revenue in the future, and that would be a tax asset of 5 million. Question on any of that? Okay. Then come over and let's take a look at this idea of valuation allowance. Okay, because we are reporting deferred tax assets, right? Do we know exactly what that deferred tax asset's going to be? We don't, because what? We're sort of estimating, for example, what we think people are going to come in on on liabilities and warranties in the future, right? Okay, as an example. So since we don't exactly know whether or not we're going to take that, they require the company. By the way, guys, I'm going to hand out the sign-in sheet. I'm not sure who decided that, I only needed this much paper for this last time. Don't do this. Because now I got to carry around a comfortable piece of paper that I don't want to. So just leave it on the sheet, okay? And go ahead and sign in. Sign your name up there and then pass it to another person. So, okay? That's the sign-in sheet, okay? And don't tear it off. But I appreciate it, but I don't. These things get lost, okay? Okay, so we come over and we don't know for sure that we're going to be able to take advantage of that asset. And so what they require management to do is look and do an evaluation to see if it is more likely than not that they will, determines that it is more likely than not that $3 million of the deferred will not be realized. So if you get to a situation where more likely than not means more than 50%, you think you will not actually collect on that, they make you, on that tax asset, you realize the benefit of that tax asset, they require you to report a valuation allowance against that asset, okay? Now you look at that and that sounds like, well, geez, that's the hardest thing in the world. But all you do is you go ahead and you credit the valuation allowance, thus reducing your deferred tax asset, right? And if you reduce your deferred tax asset, that is equivalent to saying that what? Well, I'm going to have more expense, right? Because you're now saying that I don't have that future benefit of having less tax in the future. So you go ahead and you debit the tax expense this period. Okay? And so you just look at the valuation allowance. This is just the presentation of it. You still report the deferred tax asset gross, don't you? But then you show a valuation allowance against it, and that's for whatever amount you think you're not going to realize the benefit of. Okay, now, it's similar to what we've seen for the deferred tax asset liability approach for the valuation allowance, in that you look to see what you need in the valuation allowance versus what's there. So if they look and in that next year they determine now they only need $500,000 in the valuation allowance, and they're sitting there with what? This is $2.5 million. Then to end up with what? $3 million here? $3 million. To end up with what? To end up only with 0.5, they have to debit the valuation allowance for 2.5, right? And so when they debit the valuation allowance for 2.5, now they decrease the tax expense, because they're saying, hey, I think I'm actually going to benefit from more of these deferred tax assets than I thought. Yeah, it's kind of like the unrealized thing, but remember, what we're doing is we're adjusting what we had done previously on the other slides. And the other slides we've done what? We've lowered our income tax expense, we've increased our tax expense for liabilities, for assets. Well, let's just talk assets, increase assets, right? So we've decreased our tax expense for these assets, right? And then after we have these assets, we have to do an analysis to see if it's more likely than not that we won't collect. And based on what we think we collect, we're going to make an adjustment to the valuation allowance on one side, and the other side is going to go to our tax expense, because how we calculate our tax expense when we put it into the asset category was affected, right? So we're just sitting there and now making an adjustment instead of making an adjustment straight to the deferred tax asset, we make it to the valuation allowance, and then the resulting adjustment goes to our tax expense, which is how it went when we had set it up to begin with, right? When we calculated at timing differences. So yeah, I would put it in the same ballpark, but it's a little bit different, and then we go through that process of figuring out what we need in the asset account, and then we're essentially backing it out through this valuation allowance. And in this case, we actually put more in because there was too much in the valuation allowance. So I would put it as a, kind of a two-step method, whereas for unrealized holding gain and loss, it's kind of one step. You compare the value of the asset to its carrying value, and that's the amount that you determine you need in the fair value adjustment account, and then that's going to determine the gain or loss. Here we go ahead and figure out what do we need in the asset account, and then we do that's step one, and then step two is to figure out how more likely not it is that we won't collect some of that when we make an adjustment to the valuation. Yeah, I would say that would be step two, because we first figure out, because remember we're putting the asset gross, right, and then we're making a valuation allowance for it. So I think you'd first say, okay, this is what we're saying will be future amounts, but how likely is it that we'll actually collect on that and put a valuation allowance on that? And there could be various reasons that could cause us to change this. For example, let's say we're sitting there and we're thinking, well, we're not going to have income in the future. We're going to be, taking some other expenses in the future that really aren't even affecting this year because we have some sort of project. We know that we're going to be incurring additional expenses, or we're going to have some losses coming up that we'll look at carry forwards later. Okay, so we're not going to even have income. Well, if that's the case, what's the chances that you're going to take advantage of that full tax asset if there's not even any income to write it off against, right? And so there's different factors that can come into it. That's why I think it's a second step. Okay, so you come over valuation allowance. Let's take a look at this question here. And they tell us that we have a deferred tax asset of $100,000, and at the end of 2018 we had a deferred tax asset of $100,000, and believed it was more likely than not that it could realize any of the tax deductions associated with the deferred tax asset. Okay. So at the end of 2019, at the end of 2018, notice the entire amount is in the valuation allowance. So I mean, it's kind of funky in that way. You say, here's my asset, and guess what? I'm not going to get to collect any of it. Boo, right? And so you put the whole amount in the valuation allowance because you're thinking, for whatever reason, you're not going to collect on it, right? Then you look at the end of 2019, and Elliott needed to show a deferred tax asset of 150, and believe it was more likely than not that it would realize more likely than not that it would realize 20,000 of that. And so if that's the case, assuming tax payable of 300,000, no deferred tax liability, our tax expense journal entry would include what? Well, the first thing we need to do is figure out how much we need in the valuation here. Okay, just go ahead and I will show you how to calculate this. And so what happens? We go ahead and we determine that we needed 150,000, so we have to increase the deferred tax asset to 50,000 from 100, right? And we have to get at that. And then we take a look at the valuation allowance, and the valuation allowance we say is what? Now we want 30 in there, and it needs 130 because what? We say there's 20,000 that we would not realize, right? But we don't need 150 evaluation allowance, we only need 130. It has 100, so we put 30 more in, right? Okay? And so you take a look at this journal entry now, and remember the tax expense is always the one to balance. They told us taxes payable were what? 300, so we set up the taxes payable. We set up the credit to the valuation allowance. We debit the deferred tax asset here, 50, to bring it up, and now we have tax expense of 280. Okay. 130, because they told us that we had a deferred tax asset of, well, they told us it was more likely than not, assuming tax payable 30. They tell us that deferred tax asset was more likely than not, it would realize 20,000 of the deferred tax assets. So we need this to, the valuation allowance, to have this be a net of 20, right? Because they tell us it was more likely than not that it would realize 20,000 of the deferred tax assets. So if I'm sitting here and I have 150 deferred tax asset, and I needed to show net, what, 20,000? The amount that they think that they will collect, right? Yeah, more likely than not that they only realize 20,000. Did I say the opposite before? Maybe I said that they didn't get 20, but it's more, they think they're going to only get 20, right? So since the net is 20, if this is the deferred tax asset here, and the valuation allowance is here, then I need 130 in the valuation allowance, so the net is showing the 20 the amount they think they're going to collect, right? And so to get it to be 20, we need 130 in the valuation allowance. It already has 30,000. So 100,000. So we put 30,000 more. Yeah, it would, like we saw on the. You could probably footnote it somewhere, okay, so that you show it net, but this would be another way to show it. Here's the deferred tax asset less the valuation allowance, estimated net realizable value of the deferred tax asset. No, the valuation allowance it stops at 0. It can't add to the amount that I'm going to collect. Okay, so the adjustment you make to the valuation allowance is whatever you need in there at the end of the period. So since I need 130, I had to put 30 more in this example. But no, if it's 0, that means I think I'm going to be able to take advantage of the entire tax asset, right? But you can't add to it. Okay? Okay. I don't care about the disclosures. By the way, Doughton said that he would be willing to show you how some of these things are actually disclosed in financial reports, where they show up in the financial reports. So he might actually be showing you some I always call them call reports because that's what banks call them. The K1, 10K reports, I should say. They'll probably show you some of those that corporations file and some of this stuff would be. Okay, permanent difference is what? A permanent difference is not temporary, okay? So what happens with a permanent difference? It'll never turn around. It's something that will never be taxable, that we report for our book purposes, for example. And the classic example is interest on municipal bonds. We've talked about that, are not taxable at the federal level, right? So you'd never pay tax on that interest on a municipal bond. Meanwhile, we're sitting here and what? We are recognizing that as income for our book purposes, okay? So what are we going to do with those? The answer is ignore them. They do not enter into our calculation of deferred tax asset or liability because what? They never turn around. So the trick to a permanent difference is to what? We say about sharks, leave them alone. Don't touch it. Okay, just ignore that if you get that in a question, okay? So you come over and they give us different things that could generate permanent differences. And guys, I'm not interested in you knowing whether or not something's a permanent difference or not. So I'll only put questions on the test that call it out as a permanent difference. Okay, like you said, again, this is not a tax class, so I don't need you to know, well, life insurance is not, taxable, whatever. That's not what we're here for, okay? I just want you to know how to treat a permanent difference, which is to what? Leave it alone. Don't do anything with it, okay? So we come over, and they tell us it's easy because we simply ignore it. Now, I could ask you, though, the effective tax rate. Effective tax rate is going to be my tax expense for the period divided by my pre-tax accounting income. Now, when we looked, we were just using that 40% rate, right? But what happens? Because I'm including some things in my income that will never be taxable, that means that my tax rate is actually what? My effective tax rate is actually a little lower, okay? And so you come over and you take a look at those. Okay, municipal bonds. I'm not going to ask you this one, but anyway. Oh no, I guess I could say the interest is not taxable, or I'd probably call it a permanent difference. Okay, but if it's a permanent difference, what? The tax expense will not be affected. Okay, you're simply going to ignore it. Okay. Now, one of the reasons that I can't let you sit there and watch TV while we're in class is because then the person next to you thinks that it's their turn to watch TV, right? And pretty soon I've got a whole class full of people watching cartoons. That ain't gonna fly. Okay? So if you were absent for one of the days, like let's say you missed the test, the day after the test and you didn't show up, and you asked me to, give you consideration because you had something important to do in class, and then you turn around and you come to class and you watch TV, I'm not going to give you those points back, and I'm going to go ahead and penalize you for being absent that day, okay? So if you want to play with me, go ahead. And I will win because I control the grade book, okay? All right, so let's go ahead then and let's take a look at this next one. And if you're that good that you don't need to be here, just don't come. Don't come. Don't get any of the points for the homework. Don't get any of the points for the quiz. And just score well on the test, right? I mean, you've got the whole thing under control. Okay? Okay, good. Now you come over and you can see here that they give us this situation where we have these municipal bonds of 5. And we know that we're never going to pay tax on that, right? So are we going to use that at all for our calculation of our deferred tax? I guess we got a deferred tax liability here. Are we going to include that at all? Okay. So when we start to sit here and figure out our deferred tax liability, right? We're going to do what? We're going to sit here and we're just going to use the 40, just the temporary differences, right? Okay? So we come over and we have what? We have this $40 difference, 40%, that's future amounts, and we just go ahead and take that into deferred tax liability like we've seen. Okay? And the 5 did not affect it at all, right? Okay? Now when we go ahead and we do our effective tax rate, yeah, now we're interested in what? In sitting there and saying, well, look, our effective tax rate is the $56 million of tax expense that we have here, divided by what? The $145 million of income that we had. So our tax rate is actually what? Our effective tax rate is a little bit lower. Okay? The total tax expense is 56. It's the deferred plus the current, right? Divided by our pre-tax income. Okay. And then okay. Okay, I'm gonna stop there, okay, because I don't want to keep going into tax rate considerations at this point, because I think that we keep going and it just starts to be like, okay, what are we talking about anymore? So next time, we will get into tax rate consideration, and we will talk about what happens if we have what we call carry forward on our losses. Okay, we have losses carried forward. We're going to treat that a little bit differently. We'll go through those, and we will go through the quiz for this chapter, and then on Wednesday we'll go through the pension chapter quickly. We'll go through the quiz for the pensions, and then on Thursday we'll start the practice midterm. We'll have that as part of our discussion on Friday and Monday next week, and then our test is on Tuesday the week after, right? Okay? All right, guys, I will see you on Tuesday. As I said, Dalton will be here tomorrow and Monday. Okay, tomorrow and Monday for the discussion. All right, guys. Oh, okay, yeah. You want to sign it? I'm not sure.
不知道是哪一节课，但上节课没有传到我们那儿去。Sir, is this should we sign every classes?
When I ask you to, yeah. I don't always ask you, but if I ask you, you should sign it.
Maybe I don't.
Thank you.
I didn't sign.
Thank you. Okay.
Yesterday.
You can do it now. I'm not sure why this pen is here. But... Okay. Whose pen is this?
And
Okay.
I got a basic question for you. Maybe I just don't catch up or I'm missing something.
Hang on one second. Let me stop the recording, because otherwise we're going to have to record this whole conversation.